to tell you what are the trends. Now, in normal times, that's a tricky one to say because none of us has a crystal ball. But with this year, oh boy, all bets are off, frankly. I've spoken to a few contacts in different parts of the financial world, and every single one of them has basically said, but essentially they're saying the only thing that's certain for next year is uncertainty. And this is a word, uncertainty is a word that's being used a lot about financial services, about the financial world, and frankly, the world generally at the moment. Really what they mean actually is pessimism. Because, you know, we live with uncertainty all the time, particularly in Britain. We've no idea what the weather's going to do tomorrow. But when it comes to finances, at the moment, because of the kinds of things that have happened this year, and the reversals of all our expectations, they're just saying, we really don't know and we are nervous. They're particularly nervous about this. Yeah, absolutely. Because what we do know is the probability, and crucially it's only a probability, it's not an absolute certainty, but there's the probability that Article 50 will be triggered in March next year. Probably we will have Brexit, we don't know, we might legally not even be allowed to do that. If we do, we have the possibility of a hard Brexit, possibly a soft Brexit, possibly a scrambled Brexit, poached, I don't know. But these are all, you know, just some of the possibilities. We're not sure, but we're really not sure if we like these either, that are coming through in what I'm finding from people in the financial services arena right now. So the question, as the Chancellor Philip Hammond asked in the autumn statement last week, is this: how do we respond to the challenges of a more difficult time ahead, particularly when we don't know what those challenges are going to be? So let's look at a few figures first. These are, you know, there are a few known knowns and quite a lot of known unknowns. So I'm going to start with the really not great news first. For a start, the Office of Budget Responsibility, the OBR, is predicting lower growth for next year, down to 1.4%, and then they're expecting 1.7% the year after, 2018. And then inflation also is likely to go up to 2.75%. Of course, if Brexit doesn't happen in March, then this could all be reversed. But if we have a hard Brexit, it could be even worse than that. So happy days. Also, cumulative public borrowing over the next 5 years is now put at 122 billion, and that's more than was expected. 122 billion more the government is needing to spend, and the vast majority of that is because of Brexit. Also, the fiscal surplus target that George Osborne set, that we would be in actual surplus as opposed to debt by 2019-2020, that's just been ripped up, thrown out of the water, because the government is going to have to spend to keep the economy going, to deal with the shocks that we are expecting to come. And I just thought I'd add in Credit Suisse, not a British bank, of course. Credit Suisse, their global wealth report says that Brexit has already knocked off 1.2 trillion of British households' wealth, that we're already about to be 10% poorer. So jolly stuff, all very jolly. Essentially, we're expecting to have fewer pounds in our pockets, and for those pounds not to stretch as far. Now, I should say at this point that I actually voted Remain, and I was shocked at the Leave vote. And you know, I'm the sort of person who, anytime these figures come out, I go, see, told you, see, exactly what I said. And yet, even though people like me, and far cleverer people than me, were predicting terrible things happening, you know, if we came out of Brexit, actually, so far, the economy's been really resilient. And here are a few things. Just last week, we heard that the government borrowing fell by more than was expected to 4.8 billion in October, and that's thanks to record amount of tax income for that month. So business was doing very well, thank you very much. In fact, overall tax income in October was the highest since records began, driven in part by a 23.6% jump in corporation tax receipts. Also, the amount borrowed in October was 1.6 billion lower than the same month last year, before Brexit. Also, the stock market's very happy. Here's a FTSE 100, nasty sharp dip, as you can see, just after the vote. And then, thank you very much, doing very nicely. It's about 400 points above where it was in January. So again, that sort of Armageddon that people like me were predicting, oh no. And also, as of the end of June this year, wealth per adult in pounds sterling was 6% above its level a year earlier. So there's Credit Suisse saying, oh yeah, 10% poorer, but actually, at the moment, we're doing all right. And also, incredibly to me, the markets are up, even after the Trump win. The American markets are doing very nicely. The dollar's fine, perfectly happy. I thought the dollar would be on the floor. Oh no. No, they're actually quite happy. The markets apparently are expecting a lot of spending in infrastructure in America, and they're also very happy that, as far as they can tell, Trump is not going to put extra taxes on investing and all this kind of thing. So, things are not nearly as bad right now as those like me in the Remain camp expected them to be. On the other hand, of course, there is the fact that we haven't left the EU yet. And this is something I do keep saying. People go, yes, it's fine, perfectly all right, we'll be fine. I went, no, hang on a second. We're in the phony war at the moment. We haven't actually left. We say we're going to leave, but we haven't actually done it. Nothing's changed, really. We're still trading in the same way. Also, you could say that there's a lot of momentum from the good work that's been done over the last few years. When we had the vote, the referendum, we were already coming up as an economy. So you could say, well, it's just carrying on to where we were before. But there are quite a lot of things that are going to be happening that we are aware are going to be happening next year, that it's worth knowing about. And there are also some assumptions about what's going to happen next year. So I've got a few little, I was going to say facts. Some of them are facts, some of them are assumptions. Let's have a look at these in different areas. Now, firstly, interest rates. Now, until a couple of weeks ago, I was saying, obviously, we're not going to have any rate rises. Hardly. No, they can't do that. Oh no, actually, over the last few weeks, it's been quite clear from swap rates, those are those rates that people use to swap with I could explain it too. I'm trying to explain it, but it's a little bit too complicated. So you have the swap rates which assume what's going to happen with interest rates later on. And those swap rates are assuming interest rate rise for next year. Now this goes against what we would assume with an economy that's actually a little bit turbulent. But apparently with inflation going up, and also there's a sense that business could actually improve with low sterling. They're assuming an interest rate rise. So this is something that's a surprise. It may happen, it may not, but at the moment, it's looking quite possible. Also in the banking arena, one quite interesting move by the FCA, the Financial Conduct Authority, is to have an open banking movement. So we'll see the first stages of it next year, people being asked what they think of their banks. This is all part of a move to make things more transparent, because the government and the FCA are wanting to create more competition, something you know about, to get people switching more. because they are not at the moment. With insurance, I think the extra insurance premium tax will be kicking in next April. Insurers really unhappy about that. And that could have an effect on people's willingness, ability to take out various insurance products that they don't have to do. I think travel insurance is likely to take a hit, partly because of this, and of course partly because low sterling and the increased cost of flights. With property and mortgages, as I say, it's an interesting time with interest rates. I think interest rates may go up, as I was saying earlier. However, I don't think they're going to go up by very much. As I say, in turbulent times, you don't want to mess about too much with the interest rates. So it's likely that mortgage rates will stay low still, but we're already seeing an increased nervousness that borrowers have in lending to just anybody, if you like. They're starting to increase the deposit that you have to put down, and I think that's likely to continue next year. So borrowing is likely to stay really cheap. I mean, it's historically incredibly low now, so it would have to go up a lot to make it even, medium priced, let alone incredibly expensive. So I think it's going to stay cheaper, but they're going to be a lot pickier about who they lend to. In pensions and investments, we have the Cridland review coming out next year. John Cridland is looking at what age people should be retiring at. He's looking at the whole state pension generally, what's fair, what can the government afford, etc. And the issue of affordability is a big one, I think, now, and increasingly so, because the government has less money to play with, even less than they did under Osborne. There's very, very little wiggle room because they're having to spend as much as they can on the fallout from Brexit. So it's quite possible, I think, that the triple lock on the state pension, that's where pensioners are guaranteed a rise each year either of inflation, wages, or 2.5%, whichever is the greater. How generous is that? That's supposed to be locked until 2020. I think they might move to unlock that fairly early because the bill for the state pension for this country is 92 billion per year. So a lot of cash to be giving out as pensions. And finally, when it comes to energy, very interesting times ahead. Tomorrow, there's a meeting in Vienna of the OPEC members, and already there's all sorts of ups and downs. Nobody has a clue, frankly, what they're going to come out with, because it was assumed that they would discuss making oil more expensive, but now the Saudis have said they're not going to take part in the meeting. Some people say, oh, oil is definitely going to go up. Others go, no, not if the Saudis aren't there, it's going to... Honestly, again, this is a whole area where there's a lot of uncertainty. Personally, I'm expecting if it goes anywhere, it's going to go up. I think that we will see an increase in the price of oil, which will, of course, move on to gas and electricity. Already, we've seen with recent oil price rises, this has affected the smaller energy providers. GB Energy Supply ceased trading on Monday. We may see more of that, so less competition possibly in the energy market, which will affect some of the comparison sites, I know. So those are some of the known knowns, known unknowns, who knows, the elements that we need to look out for next year. There are some others. Those are, I think, the most interesting points in our various sectors of the financial services. But the other big question for you, I think, as advertisers looking at search, particularly thinking about what people are going to be searching for, how they're thinking, is this question: how are consumers feeling? Because, of course, we're all people, and it's the consumers that you're selling to. And what I'm seeing myself and hearing through my website, Money Magpie, from our readers, our listeners, our viewers, is, again, a total sense of uncertainty and nervousness. They feel that things are going to get tougher for them next year. They don't quite know how, but they feel that it's going to be more expensive. This is something that was noted last week around Black Friday. I say Black Friday, like 2 weeks, really. I mean, it doesn't seem to finish, does it? But one of the reasons people were rushing to the shops, rushing to buy, is they're expecting it all to get more expensive next year. But they don't know. Nobody knows, and they are basically nervous. And I think the bad news for you in some ways, certainly for the comparison sites and for some of the financial companies, is I think this means that people are going to be less likely than before to switch. They're not going to want to move quite so much. I say quite so much. They haven't been switching that much up to date. But when you think, as everything is swirling around you, even the ground under your feet, you're not sure if that's entirely solid now. It's human nature to hunker down and batten down the hatches and just stick with what you know. You don't want to rock the boat. So I do feel that this is the way that people are going to be. It's going to be even harder to get them to move. I say even harder because this is something I've noticed over the last few years. People are not that keen on switching. In some places they are. Car insurance is one area where there is movement. There's a decent amount of movement. I think a lot of people have seen the value of switching with car insurance. But practically everything else, I'm getting a sense of annoyance, resentment, anger even, from customers, from consumers, that suddenly they've been empowered. You know what marketeers call customer empowerment? To the customers, much of the time when it comes to financial services, they just find this very annoying. They don't see why they should. They're quite happy to do it with holidays. Oh, spend hours online comparing this, having a look at that, maybe this country, maybe that. They'll do it with washing machines. They'll do it with fashion. Frankly, they'll do it with practically everything but financial services. And I think part of it is because they feel that it's an imposition. Why should they? I mean, here's something from one of my readers on Money Magpie, Alex. He says, it's a job of work. It takes time and effort, and it doesn't always save you the money you think it will. Broadband's especially difficult. Yeah, it is, I have to admit. Yes, broadband is especially difficult. So this is what I've been hearing, and I think this is what we're going to get even more next year as people are wanting to stick with what they know, even if they don't like it. Because this is the daft thing with financial services. It doesn't work in the same way, in the usual consumer principles. It doesn't have the same ones. Because if you don't want to go to Starbucks because the coffee's rubbish and the muffins are just dry, frankly, you'll go to Nero or you'll go to Pret. But or if you want a holiday, you think, shall I go to France? No, actually, sterling isn't buying enough. Oh, no, maybe I'll go to Turkey, or maybe I'll go to Thailand. But with financial services, people think of their banks, I'll start with banks particularly, in the same sort of way that they think of politicians. There are people who say, oh, what's the point of voting? They're all the same. And it's the same with banks. Well, with NatWest, no, they're rubbish, but then so's Barclays and TSB, Santander. That's really the way they're thinking. And I think that is why, out of 65 million bank accounts in the country, just over 1 million switched in the last 12 months. And that's with cash incentives on the table. So I think that your mission impossible, if you would care to accept it, ladies and gentlemen, for next year, is to get your customers, the potential customers, loving your brand. You need to get them loyal, loving you, a sense of warmth. So it's about retention, I think, more than getting new ones. And the idea of retaining cosseting, cherishing the people you have now, I think has a double whammy. Firstly, you're pushing at an open door, because having said that people don't like banks, they don't like insurers, they don't like all of this, they want to like you. And this is something that I found in 2008 when we had all the last crisis, as it were. There was a sense of being people were being hurt. They felt hurt that their bank was doing this to them, that their insurance company, why are they doing this? Because we want to like our financial services. We want to feel that they are good, that they're part of us, that they're helping us, because it reflects on me which bank I have, which insurance company I have, which energy company I have. Because if they're good, I'll go, yeah, see, I'm the First Direct, great service. Oh yeah. Or yes, we have people writing and going, I wouldn't change from OVO. They're marvelous, marvelous people there. We had somebody, we asked actually on Money Magpie, we asked our readers, would you prefer to use a comparison site and get the cheapest energy, or would you prefer to get the very cheapest offer that your current provider gives you? All of them, every single one that replied said, rather stay with who I've got. Yeah, they're fine, can't be bothered. So they want to love you, they don't want to be bothered to move, and they want to feel that they've made the right decision. Secondly, of course, by being loyal, by giving all sorts of jollies to your own people, those who are not with you will be looking over the fence and going, oh, so they get that too. Oh, that's nice. Oh, maybe I'll stick with that then. Like it. So they will actually come to you rather than you having to entice them with cash incentives or something similar. Here's a quote, earlier in the year, as Compare the Markets. Oh yes, Compare the Markets here. I was on a panel called the Institute of Inertia, set up by Compare the Market, and we had focus groups of all sorts of different people, and something that came out over and over again from these focus groups was they wanted to be rewarded for loyalty. Here's one of the quotes. It said, I think they have no loyalty to us, and therefore we have no loyalty to them. Maybe they need to change the way things work and show that loyalty pays. Yeah, I totally agree with this, because in far too many parts of financial services, loyalty really does not pay. In fact, have a look here in insurance, homeowners, this is according to an FCA report, homeowners paid 70% more for loyalty over 5 years versus consumers, new consumers, in home insurance. So that's just home insurance. 70% over 5 years, that's how much more you pay if you are loyal. This sort of thing should not be. So I suggest that in the next year, particularly as it's feeling like a very cold climate, you need to make your consumers, your customers feel warm about you. They need to feel like it's a family, like it's a club, because people want to belong to clubs. They want to belong. It's a fundamental human thing. We want to be part of a family, a team, a club. We want to belong, and we want to be able to kind of boast about the goodies we get as part of this club. For example, Cineworld, Cineworld Unlimited. Does anybody belong to Cineworld Unlimited? Oh, you do, yes, absolutely. So you get unlimited downloads, you get to see lots of films, and crucially, you get 10% off snacks and drinks in the cinemas, don't you? Oh yes. But even more crucially, if you stay for over 12 months, you get 25% off your snacks and drinks. So you are actively rewarded for that loyalty. And I know people go, oh, I couldn't leave because I get 25%, if I leave before, you'll be given it. You what?
You'd also be 18 stone as well.
Oh yes, you also be 18 stone, absolutely. So then you have to join a gym that gives you extra cinema help. Apparently, if you do stay, after that, your red card turns into a black card as well. Yeah, cool. Black card. Think about that, insurers, absolutely. Actually, some financial companies are getting into it. One of our readers in Sheffield said that Virgin Money, apparently, they have lounges which you can sit in for free. He says, I have meetings there and it's really cool. So they are creating a kind of an affiliation brand. And yeah, that is cool. I was thinking, oh, damn, I must have a look at that because I like to have places to have meetings in, something that isn't a cafe, which is where I tend to work. You know, a free cafe lounge, which apparently free coffee. Hello, what more would you want? So they've got a club feel. And also Talk Talk. I'm sure you've, does anybody do Talk Talk here? Anybody represent Talk Talk? Oh, well, anyway, they are also, at the moment, they've got an advert which is showing that these new goodies are for existing customers as well as new customers. So again, this was something that we found at Institute of Inertia. People were very irritated at the idea that only new customers could get these special offers. So I think this is the way to go, to be offering exclusive deals to existing customers, or exclusive deals to existing, well, not that exclusive, deals to existing and new customers, and rewarding loyalty where possible. If this can be put forward in the search, in the adverts, that look, we're looking after our own, yes, come and be part of our club and you'll be looked after too. That kind of a message, I think, is what's going to be helpful in the next year. Customers need a club, a family, a belonging, something that they can warm to, feel proud of, feel part of, tell their friends about. Guess what I get when I'm a member of this? My bank gives me this, my energy, you know, this type of thing. And in these uncertain and frightening times, I think they also, in your advertising, in the messaging, they need a sense of safety, security, certainty where possible. And I put certainty there thinking, should I take this off? Who can give certainty at the moment? But at least some sort of sense that you are with them, you are solid, you are holding them up, and you're going to continue to be there. So when it comes to imagery, wording, videos, etc., I think a sense of security of your company is great, you know, rock, castle, these kinds of things. But also, I do feel that, and I've noticed it, I don't know if you've noticed this on social media, in the last few months have been a lot of posts of people going, really need a distraction at the moment, have a look at this video, or have you seen this dog bouncing up and down in front of John Lewis out, isn't it brilliant? This is what more and more people are looking for, you know, a John Lewisness, something that's happy, that will take their mind off things. You know, kind of, oh, times are hard, your insurance is going up, here's a kitten to have a look at. I know it's cheesy and it's even childish, but boy does it work. We found, again, on Money Magpie, you can say anything. If you've got a puppy there, people will click on it. A kitten, they'll click on it. It's a basic thing. It's also simplicity, because I think simplicity is increasingly important, and I know it's very difficult with, what do they call themselves? Compliance. Yes, I feel your pain. Oh, I've dealt with compliance. They are not of this world. But yes, the more simple the message, the better. Actually, I wasn't going to mention this, but one of my favourite stats this year is that in 2009, this is according to the Money Advice Service, in 2009, in 2005, 9% of the population couldn't pick out the balance on their bank statement. So you gave them the bank statement, didn't know what it was. In 2015, 22% of people couldn't pick out the balance on their bank statement. How did this happen? But Money Advice Service, I'm guessing, you know, they know what they're talking about. So truly, the simpler, the bigger, the bolder, the more obvious images, the better for this kind of messaging for financial services. It is basically, as I say, animal images, comfort food, cartoons. I noticed Halifax is using that. Halifax is using nostalgic cartoons, which I thought was quite clever. It's interesting to see those kind of things, back from what people think of as a happier time. I remember the 70s and 80s, they weren't that much different, but anyway, That is the feeling. Nostalgia is something that's making people feel a little bit more comfortable. Edgy is not where it's at, even with the millennials. Yes, I'm going to mention millennials as well, because they're, in some ways, they're more worried than others. It's comfort that people are needing now. Finally, though, I wanted to leave you with this thought about the potential positive side of what we've been going through this year. Because you never know what good things are going to come out of this. I read the other day that if you had put £5 on a bet that Leicester City would win the cup, that we would leave the EU and that Donald Trump would become president, you would now have £15 million because Paddy Power put those three things happening at 3 million to 1. Well, 3 million to 1 has happened, and I'm hoping somebody's made 15 million out of it. But it shows you that surprising and often quite good things can happen when you don't expect it. And you know, there's something I felt just in the last month or so of that when bad things or when big things happen, whether they're good or bad, when big overturnings happen, as we've had this year, there's a new energy that is created. And I've started to feel this. I've heard it from some of the more bullish pro-Brexit businessmen that I know. They're like bullish, and I go, yes, it's definitely we're going to go forward. There's great things for my business, great things for Britain. And there's a general energy, there's a newness. Because, you know, when you think about it, if we had voted to remain and if Hillary Clinton had got in, most of us would have gone to work the next day and gone, well, business as usual, which is fine, no, because business was gradually coming up. But it's not business as usual. And although it feels like we've had a really cold blast of air through our experience recently, it's not comfortable, but boy, does it blow away a lot of cobwebs with it. So it's worth being open, keeping our minds open to the new possibilities that are coming in next year, to be open to the new potential, this new energy, which I think will probably grow. I'm not sure in what direction, but it brings out a lot of new potential opportunities. So let's keep our eyes open and let's keep our thought open and let's get quick in our responses, because I think there are some really good possible opportunities coming for everybody in this room. So let's go and grab them. Thank you.